You finally saved up your first $1,000 to invest. But here's the truth. Invest it the wrong way and you'll lose years of growth. Invest it the right way and it can be the foundation of real wealth. I've helped millions improve their finances, and I'll show you exactly how to do it step by step, even if you're starting from zero. So why is this first $1,000 such a huge deal? It's the seed for your financial future because of a force called compound interest. Think of your $1,000 as a small snowball. Getting it invested is the first push that lets it roll down a long hill, picking up more snow, getting bigger and faster over time. Your money is making money, which then makes its own money. You've already done the hard part by saving the money. The goal now isn't to get rich overnight, it's to put that money to work, because time is your most important ingredient. Before you invest a single dollar, you need a solid foundation. That means handling two things. First, high-interest debt. I'm talking about credit card debt or anything with a double-digit interest rate. The interest you're paying, often over 20%, is much higher than the stock market's average annual return of around 11%. Paying off 20% interest debt is like getting a guaranteed 20% return. If you have that kind of debt, your first $1,000 should be used to destroy it. Second, an emergency fund. This is 3 to 6 months of living expenses in an easy-to-access savings account. It's your life happens money. Without it, a surprise bill could force you to sell your investments at the worst possible time. So an emergency fund gives you the peace of mind to invest for the long term. Alright, debt is handled, and your emergency fund is ready. It's time to invest. But what do you buy? Amazon? Bitcoin? We're going to ignore all of that. The best strategy is not to find the needle in the haystack, it's to buy the whole haystack. You do this with a low-cost, broad market index fund, like one tracking the S&P 500. Think of it as buying a tiny slice of the 500 biggest companies in the US. Instead of betting on one company, you own a piece of them all. This gives you huge advantages. First, instant diversification, so your risk is spread out. Second, it's incredibly cheap because it's passively managed. And third, it just works. Over the long run, simply buying the whole market has been shown to outperform most professional stock pickers. Let's walk through the 3 simple steps. Step 1. Pick your platform. You need a brokerage account. Don't overthink this. Any big reputable name like Fidelity or Vanguard is a good choice. Step 2. Open and fund your account. Opening an account is simple. Go to their site or app, provide some info, and once approved, connect your bank account to transfer your $1,000. Step 3. Buy your first investment. Now, with the money in the account, you'll search for a broad market ETF that tracks the S&P 500. Some popular ones are VOO, SPY, or IVV. In the trade or search bar, type in one of those tickers. Thanks to fractional shares, you don't need to afford a full share. Just say you want to invest your $1,000, hit buy, confirm, and that's it. You are officially an investor. So you've bought your first investment. The immediate temptation is to check it every day. This is the biggest mistake you can make. The stock market always goes up over time, but it doesn't go up in a straight line, it zigzags. There will be days when your $1,000 is worth $900. This is normal and very much a part of the long-term growth journey. Your job is to be an owner, not a trader. So don't worry about this week or month. Focus on the next 10 plus years and watch your money grow. Remember the plan. Pay off high-interest debt and start an emergency fund. Then open a brokerage account and invest in an index fund for the long term. You're off to a good start with your first $1,000, but 4 common mistakes could be costing you thousands more. Watch this video to stop investing on hard mode and maximize your returns.